All right, let's get right into it. You know those stocks, the ones that just seem to explode out of nowhere and define an entire market cycle? The big question, the million-dollar question really, is how do you spot them before they blast off? Well, today we're going to pull back the curtain on one of the most legendary systems ever built to do just that, William O'Neill's CAN-SLIM framework.
And this was the exact question that William O'Neill himself was obsessed with for decades. He basically became a stock market historian, digging through charts of all the biggest winners cycle after cycle, looking for clues. And what he discovered was pretty amazing. Their incredible success, it wasn't luck, it wasn't random. There was a pattern, a repeatable blueprint. And yeah, you guessed it, that blueprint is CAN-SLIM.
I love this quote because it just nails the whole philosophy. CAN-SLIM is not about dumpster diving for cheap, beaten-up stocks. Forget that. The goal here is to find the financial equivalent of a Mercedes just rolling off the assembly line. We're talking about elite companies, top-of-the-line fundamentals, and buying them right at that moment they hit the gas. It's all about buying strength, not weakness.
So here's how we're going to break it all down. First, we'll look at what I call the financial engine. Then we'll talk about the ignition switch, what gets these stocks moving. After that, we'll cover how to make sure you're riding the market tide, not fighting it. And finally, we'll get into the super important buy and sell rules.
Okay, part one, the financial engine. The first two letters, C and A, are the guts of the whole thing. This is where we look under the hood at the raw numbers. Think of it like the horsepower, the fundamental strength a company absolutely needs to power a massive run-up in its stock price.
So the C stands for current quarterly earnings. And the number you need to remember is this one, 25%. The system is looking for companies whose earnings per share, or EPS, have grown by at least 25% in the latest quarter compared to last year. And I gotta stress this isn't a nice to have, it's a hard and fast rule. It's a filter designed to find the companies that are firing on all cylinders right now.
But look, one great quarter, as amazing as it is, just isn't enough. The system is way more demanding than that. You can see the benchmark for earnings is that 25% or more. But check out that next line, EPS acceleration. This is huge. It means the pace of growth is actually picking up steam. And to top it all off, you need to see strong sales growth. Again, ideally over 25%, to make sure those awesome earnings are coming from real customers buying real products, not some accounting trick. Okay, so after we've zoomed in on the current quarter with the C, the A for annual earnings kind of pulls the camera back. We need to see the bigger picture. We're looking for a solid track record here. This is our check to make sure the company isn't just a flash in the pan. We want to see a sustainable business that can deliver the goods year after year.
All right, so we've got our high-performance engine, but an engine is useless without an ignition switch, right? So now we're moving on to part two. A company can have the best earnings in the world, but something has to light the fuse. That's what N, S, and L are all about. These are the catalysts that create momentum and separate the leaders from the pack. The N stands for new, and this is a big one. The research is pretty shocking. Something like 95% of the biggest winning stocks had some kind of major new catalyst behind them. We're talking of groundbreaking new product, a visionary CEO taking the helm, or a huge shift in the entire industry. And this might sound weird, it also means a new stock price high. Why? Because a new high tells you that the stock has chewed through all the old resistance and is breaking into open air.
Next up is S, and this takes us right back to Economics 101, supply and demand. It's simple, right? When you have a limited supply of something and a ton of people want it, the price has to go up. In the stock market, this often means companies with a smaller number of shares available to trade. Investors call this a small float. So when the big players, the giant funds, start wanting in and buying up those few available shares, boom, the price can just take off. And that brings us to L for leader. Look, in any given industry, you don't want to mess with the number 2 or number 3 player. You want the king, the undisputed champ. CAN-SLIM has a specific tool to measure this, the relative strength rating, or RS rating. And the rule is crystal clear. You only even look at stocks with an RS rating of 80 or higher. That means it's already outperforming 80% of all other stocks in the market. That's leadership.
Now, I gotta pause here for a second because this is super important. Do not get the RS rating confused with the RSI, the Relative Strength Index. They sound similar, but they're completely different animals. The RSI just tells you if a stock is overbought or oversold compared to its own recent price history. The RS rating, the one we care about, is a head-to-head competition. It ranks a stock's performance against the entire market. One is about internal momentum, the other is about true market leadership. Okay, so we're making good progress. We've got a company with a powerful engine and an ignition switch ready to go. So what's next? Well, now we hit part 3, riding the market tide. Think of it this way. You can have the fastest speedboat in the world, but if you try to drive it straight into a hurricane, you're not going anywhere. This is all about making sure the big money and the overall market are giving you a tailwind, not a headwind. But here's the thing. You could find a perfect A-plus stock. I mean, everything checks out. But studies show it'll still fail 3/4 of the time if you ignore this one simple thing. So what is it? What's the one factor that can sink even the best of the best? The I is for institutional sponsorship. This is the big money we were talking about. For a stock to make a truly massive move, it needs the fuel that only professional money managers, we're talking mutual funds, pension funds, can provide. They're responsible for the vast majority of trading. Now, you want to see some top-tier funds owning the stock, but not too many. It's a bit of a Goldilocks situation. You want enough to validate the story, but not so many that everyone who could possibly buy already has. And here it is, the big one. M stands for market direction. And honestly, most people who follow this system will tell you it's the most important letter of them all. O'Neill's research was definitive on this. 3 out of every 4 stocks, even the greatest ones, will just get dragged along by the overall market's trend. So the lesson is simple. You have to, absolutely have to, be swimming with the current, not against it. So how do you know when the tide is turning? How do you spot the beginning of a new uptrend? Well, there's a very specific signal called a follow-through day. It typically happens on day 4 to 7 of a rally attempt off a market low. What you're looking for is a major index like the S&P 500 to close up strong, maybe 1.5% or more, on volume that's heavier than the day before. That surge in volume, that's your clue. It's the big institution saying, okay, we're back in the game. Which leads us to the final, and I'd argue the most critical part of this whole thing, the buy and sell rules. Because let's be real, you can have the most perfect watch list of stocks in the world, but if you don't know exactly when to get in, and even more importantly, when to get out, it's all for nothing. So for buying, the system uses classic chart patterns to pinpoint the ideal entry. The most famous one, by far, is the cup with handle. It's pretty much what it sounds like. First, you get this big U-shaped consolidation that forms the cup. Then, there's a little slight dip on lower volume. That's the handle. That's the final shakeout of weak hands. And that spot right above the handle, the pivot point, when the stock breaks through that level, that's your buy signal. That's the green light. But here's the absolute truth about CanSlim, and maybe about all successful investing. The most important rule has nothing to do with buying. It's a sell rule. It's not about being a genius who only picks winners. The real foundation of success is protecting your money. It's about having a rock-solid, non-negotiable plan for cutting your losses when you're wrong. And here it is, maybe the single most important number in this whole discussion. The rule is absolute. You always sell a stock if it falls 7 to 8% below what you paid for it. Period. No second guessing, no hoping it comes back, you just cut it. This single rule is your armor. It's what prevents a small mistake from turning into a disaster for your portfolio. Now, what about when you're right? Taking profits requires just as much discipline. The general rule of thumb is to take your 20 to 25% gain off the table and look for the next idea. Bank the win. But there's one very powerful exception. If a stock is a true monster and it shoots up more than 20% in less than 3 weeks from its breakout, you've got a rule for that too. You hold on tight for at least 8 weeks. That's how you give yourself a chance to catch a truly life-changing winner. So, when you put it all together, what's the big takeaway? It's that CanSlim isn't just some stock screener you can punch a few numbers into. It's a complete, integrated system. Every single letter depends on the others. And ultimately, the magic isn't in the letters themselves. The success, the real edge, comes from the rigorous, unwavering discipline it takes to follow every single rule every single time. And that leaves us with a really interesting question to think about. In today's world of high-frequency trading, AI, and algorithms, can a framework built on data from the last 70 years still work? I mean, the companies have changed, the technology's unrecognizable, but has human nature? Has the core dynamic of fear, greed, and supply and demand really changed at all? Can this old-school framework still pinpoint the market leaders of tomorrow? It's definitely something to think about.